Welcome to this explainer. Okay, today we're diving into a topic that literally changes how we view money, wealth, and the future. If you've ever felt like the stock market was this exclusive secret club speaking a totally foreign language, hey, you are not alone. But today, we're going to translate that language into a clear, actionable roadmap using some incredibly powerful concepts. We're talking about the millionaire math, the exact strategy that turns regular, everyday savings into massive generational wealth.
$1 million, right? For most of us, this staggering number feels like an absolutely impossible mountain to climb, like it's something reserved just for lottery winners or tech billionaires. But according to the math we're unpacking today, this number is totally achievable for the average earner. Get this, if you save just $200 a month at an 8% annual return, in 45 years, you'd have over $1 million. That's the math. It isn't magic. It's just a formula.
Now, I know exactly what you might be thinking. How on earth is this possible if you aren't some Wall Street pro in a tailored suit staring at 6 computer monitors? Well, that is exactly the skepticism we're tackling head-on right here. The source material we're breaking down today doesn't just toss out theories. Actually, to prove how simple this is, the creator of our source invests $10,000 of his own real money to show exactly how it's done.
Okay, so let's dive right into this 3-act playbook. We're looking at 1, unlearning the lies, 2, the rules of the game, and 3, the 10K blueprint.
So, Act 1, unlearning the lies. Do these phrases sound familiar? Our source actually recalls asking teachers about investing, only to be told it's just for rich people who can hire fancy professionals. Friends insisted you had to read complicated financial newspapers and charts every day. Family members were terrified, warning that if you start investing, you'll lose absolutely everything. It really paints investing as the riskiest gamble in the world, doesn't it? But here's the reality check. These lies are exactly what the financial elite want you to believe. They want you to think it's way too complicated, so you'll just pay them to manage your money for you. And that brings us to a massive paradigm shift. The dark truth of the financial industry is that the average actively managed fund, the ones run by those highly paid professionals, actually returns 2% less a year than the general market. Yeah, that means the pros are, on average, doing worse than a basic passive index fund. And the absolute worst part, even if they lose your money, they still charge you hefty fees. It's time to wake up to the truth here and realize that simple index funds are extremely easy, require very little money to start, and historically, they make you way more money in the long run. Let's move into Act 2, understanding the game. So, what exactly is an index fund? Our source uses a really brilliant sports analogy for this. Think of a football league table. The absolute best teams sit at the very top, right? If a team performs terribly, they get relegated and removed from the top league. Well, an index fund works exactly the same way, but you just swap out sports teams for companies. It's basically a slightly sneaky way to invest in every single top-performing company on a list with just one single click. You're picking the winning team every single time. If a few companies do terribly, it's completely balanced out by the ones doing exceptionally well. And the most famous league table in the world is the S&P 500. This is the list of the top 500 public companies in the USA. We're talking the big dogs here: Amazon, Google, Apple, Tesla. Over the last 10 years, the average return on the S&P 500 has been 13.6%. But here is the most mind-blowing fact to remember. No one has ever lost any money if they've bought and held an S&P 500 index fund for more than 20 years. Literally no one. It is a historically proven wealth-building machine. But building wealth isn't just about what you make, it's absolutely about what you get to keep. Depending on where you live, you have access to what we can call shield accounts, like the Roth IRA in the US, the ISA in the UK, the TFSA in Canada, or Super in Australia. Think of these accounts like Captain America's shield. If you invest outside of them, the government takes a slice of your profits in taxes. But if you tuck your investments inside these shielded accounts, you take that shield into battle, and your profits are legally protected from the taxmen. It's a total game changer. Now, this brings us to a really common point of confusion: ETFs versus index funds. They are very similar. Both of them allow you to buy that awesome basket of stocks. But just look at the name. ETF stands for Exchange Traded Fund, meaning you can buy and sell it throughout the day on the stock market exactly like a regular stock. An index fund, on the other hand, is only priced and traded once at the very end of the trading day. For absolute beginners who are starting with very little money, ETFs are often the better option because they typically have lower minimum investment thresholds and way fewer broker commissions.
Okay, so the real secret ingredient to the whole millionaire formula is time. It's what's called the compounding snowball effect. When you first start out, your gains seem pretty small. But as interest earns interest on top of even more interest, it starts rolling and growing at a crazy rapid pace. Eventually, you hit this magical tipping point where the interest you make is far larger than the actual monthly cash you're putting in. This is exactly why starting young is a massive advantage. In fact, if you're under 18, you can start right now by asking your parents to help you open a custodial account or a junior ISA. Time is your absolute best friend here. And hey, if you don't have a big lump sum to start with, don't wait. Just use dollar cost averaging, which just means investing what you can every single month. Sometimes you'll buy high, sometimes you'll buy low, but it all beautifully balances out over time.
Now for Act 3, mastering the strategy. So the crucial point now is actually knowing how to navigate a brokerage website. The big three brokers out there are Charles Schwab, Fidelity, and Vanguard. Vanguard is especially notable because its founder, John Bogle, is widely known as the father of index fund investing. But listen, when you first log onto Vanguard, the sheer number of options can look incredibly overwhelming. Don't panic. To make it digestible, we can break their giant list of funds down into just 4 simple categories. Let's take a look at the first 2. Category 1 is bonds. Think of bonds as a contract where you lend your money to a government or a company, and they promise to pay you back with a little interest. They are very low risk, but they're also very low return. Typically, the older you are, the more bonds you want in your portfolio. Then, category 2 is balanced funds. These are target date funds where you literally just pick the year you want to retire, and the fund automatically adjusts your mix of stocks and bonds as you age. It's exactly like driving an automatic car. Perfect if you want a completely hands-off, set-it-and-forget-it approach. But if you prefer driving a stick shift and having a bit more control, you'll want to look at categories 3 and 4. Category 3 covers company size and location. This is where you're going to find funds tracking our old friend, the S&P 500, or total stock market funds that buy the entire US market in one click. You can also buy international stocks or emerging markets, like China and India from here. Though keep in mind, those carry a much higher risk level. Finally, category 4 is sector-based investing. This is for when you want to focus heavily on very specific industries, like energy, real estate, or healthcare. And that leads us to the final piece, the $10,000 blueprint. Now, let's look at the precise breakdown of the portfolio our source built. They put 70%, so $7,000, directly into an ETF that tracks the total American stock market. That is a massive bet on the biggest economy in the world, securing small pieces of giant companies like Apple, Amazon, Tesla, and Google. Next up, to balance out that geographic risk, 20% goes into a completely different economy. In this case, the UK's FTSE 100 index, capturing huge companies like Unilever and BP. And finally, the remaining 10%, $1,000, goes into a global bonds index fund to provide a baseline of security and smooth out the stock market's roller coaster ride. The whole thing is beautifully simple, highly diversified, and remarkably effective. And that brings us to the end of our explainer. The math is clear, the lies have been completely debunked, and the blueprint is right in front of you. You really don't need to be a Wall Street insider to capture the wealth generated by the world's greatest companies. You just need an index fund, a shield account, and some time. So the only question left for you is this. Are you ready to build your shield, push that snowball down the hill, and start your own compounding journey today? Stop waiting on the sidelines. The market is ready when you are.